Thanks for joining us today. I'm Earl Winthrop,
I'm Cece Wang.
and today we're going to be discussing cognitive biases and how it affects investor behavior.
We hope you find this information useful, and let's get started.
How does investor behavior impact portfolio returns? Today, we'd like to talk about 4 cognitive biases that frequently lead to investment mistakes and solutions for mitigating those effects. To be a successful investor over the long term, we believe it is critical to understand and overcome common biases that often lead to poor investment mistakes. Cognitive biases are hardwired, and we are all liable to take shortcuts, oversimplify complex decisions, and be overconfident in our decision-making process.
The first bias is confirmation bias. We define confirmation bias as the tendency to seek or emphasize information that confirms our existing beliefs. The problem is overconfidence, which translates into investors focusing on data that appears to confirm their beliefs.
We are inundated with information. Is someone's opinion an unbiased view? What sources can we use, and who do we trust? In order to avoid the discomfort of reading information that is contradictory to our beliefs, we often seek or emphasize information that confirms our existing beliefs, causing us to be overconfident in our investment decisions. But it's so much more important to ask yourself why you are wrong than why you are right. So instead, we should stop getting news from one source and attempt to challenge the status quo and seek information that causes us to question our investment thesis.
A solution to consider is to try to seek information that makes us question our current investment view. Charlie Munger, the vice chairman of Berkshire Hathaway, said, "Rapid destruction of your ideas when the time is right is one of the most valuable qualities you can acquire. You must force yourself to consider arguments on the other side." The second bias is action bias. We define action bias as the tendency to favor action over inaction without solid rationale to support the action. The problem? Oftentimes staying grounded leads to better outcomes than taking action.
Research shows that goalies dive one way or the other 94% of the time, yet chances of successfully blocking the kick are statistically greater if you simply stay still. So what compels them to jump rather than standing their ground? It's action bias, the notion that doing something is better than doing nothing. The same concept applies to investors. Many times you may lose money if you take action in panic, or you buy or sell investments hastily after checking some news. These decisions result from action bias, as we feel compelled to do something instead of patiently following our financial plan, which is working towards a future goal.
It is important to realize that market experiences volatility all of the time. But given the time horizon and with a proper asset allocation, you are still on track for future success.
Avoiding the action bias requires us to unlearn our impulse to respond with action in ambiguous situations. So instead of reacting automatically, we should consider the consequences of both action and inaction and compare their effectiveness. Doing so allows us to engage in more informed decision-making. It is also important to not confuse action with progress. Just because you're doing more does not mean that you're getting more done.
A solution to consider: rather than reacting automatically, think through the consequences and rationalize before taking action.
The third bias is bandwagon effect, also known as groupthink. It is gaining comfort in something because many other people do or believe the same. The problem with that is that you are unable to analyze and think independently to make smart investment decisions.
To be a successful investor, you must be able to analyze and think independently. Speculative bubbles, that is, an irrational spike in asset values to unsubstantiated levels, are typically the result of groupthink and herd mentality. if too many investors crowd into one trendy stock, there is a greater chance they'll all rush out at the same time if bad news strikes. So we should find no comfort in the fact that other people are doing certain things or that people agree with us. Rather, we must focus on facts and analysis, because at the end of the day, we will be right or wrong due to our analysis and judgment being either right or wrong.
So a solution to consider would be to focus on facts and analysis rather than following the crowd. There's a good Warren Buffett quote that goes, "Be fearful when others are greedy, and be greedy when others are fearful." Lastly, we'll talk about anchoring bias. Anchoring bias is our tendency to rely too heavily on past reference or one fact or piece of information when making a decision. Most commonly seen is the anchor to recent stock prices, thinking that the past performance of a company will continue to remain the same in the future. However, we know that the market is constantly changing, so historical values are irrelevant to determining the market price of the future. Investors can counter such bias by identifying the factors behind the anchor and replacing suppositions with quantifiable data.
Another common mistake is blindly trusting analyst forecasts or expert opinions and becoming anchored to their information, which may not necessarily be correct. While research analysts can be highly paid experts, they tend to have short-term views, offering decisions in the stock market, and their opinions often can't be trusted as the basis for objective investing decisions. We believe a comprehensive financial plan is key to making any investment decisions. It is your roadmap.
It is so important to understand the person and the data. Anyone can make a bold market prediction. So you must consider the qualifications of the person, the data behind the prediction, and their past track record before taking action. Now, everything happens in real time with a never-ending flow of pundits and articles ready to pontificate about what happened and how it may impact the markets. We caution our clients to not overreact to one data point, piece of news, or what a so-called market authority might be predicting.
Therefore, instead of anchoring to specific sources, one should do thorough research on their own before investing their hard-earned money. And to avoid anchoring when the price of the shares in your portfolio goes up or down, you must check the company fundamentals before making a call to buy or to sell.
The easiest way to overcome the anchoring bias is to track one's behavior and identify the anchors that you are normally prone to be dragged down by. Then, you can overcome anchoring bias with logical thinking, due diligence, and a practical approach driven by research rather than by emotions. If you look at the chart here, which displays the annualized returns of various asset classes and the average investor for the last 20 years, you can see that the performance of an average investor was substantially worse than that of various asset classes. According to study, the average investor's return over this period was less than half of stocks and far worse than a bond allocation. This is because most investors make decisions driven by fear or panic rather than fact-based analysis, leading to poor investor returns. An experienced financial advisor can help make rational and data-driven decisions rather than ones based on emotion. In our experience, a more reasonable course of action is to combine comprehensive financial planning with a globally diversified portfolio constructed by a thorough investment process. The goal is to let the financial plan guide your decision-making so you can minimize biases and avoid emotional decisions. Just to recap what we've talked about in this video, investors are susceptible to cognitive biases that negatively impact portfolio returns. And becoming aware of these biases helps us make more informed and rational decisions. We mentioned confirmation bias, action bias, bandwagon effect, and anchoring bias. Lastly, having a financial plan and disciplined investment process are crucial to avoiding emotional decisions and guides you in the right direction for reaching your long-term financial goals. Without a comprehensive financial plan and investment process, it is very easy to shoot yourself in the foot by making an emotionally based market timing mistake. Successful investing requires skill and discipline, not reliance on gimmicks like market timing and emotional decision making.
At Winthrop Wealth, we follow a total net worth approach that combines comprehensive financial planning with portfolio management.
While financial planning and investment management can function successfully on their own, we believe that the combination produces a whole greater than the sum of its parts.
Thank you for joining us today.
We hope you found this information useful, and if you have any questions at all, please feel free to reach out to us at winthropwealth.com.